Okay, welcome to Business Deductions. First thing I want to tell you, this will be posted on Learn as well, but I want to make sure everybody's clear. I need to change the ordering of the syllabus a little bit. The syllabus says that you should do 413 for Class 8 and 416 for Class 9. I want to flip those and do 416 first. So for Class 8, please prepare 416. It's a lot more of a standard reconciliation. And then 413 is going to help us start to transition into employee thinking. And there'll be another video on that little aspect before Class 9. Okay, so hopefully that's clear. I am trying this time. I've prepared slides, and so you'll have access to the slides without any annotation, and then the slides are going to be the basis of what we talk about here. So we'll see how this works as a compromise and how it goes, and we'll, maybe we'll do a little bit of both. We'll see. Okay, so when we talk about business deductions, the first thing we have to think about is, obviously this is all about answering the question, is it deductible? Is it deductible? And so, of course, it is, an expenditure, cash out. When I spend money, should I be allowed to deduct it? Well, the first thing we have to look at is, who are you? You are a business. And a business doesn't even get to come to the deductibility party until it gets through the front door. And the front door is this concept called the reasonable expectation of profit. Okay, and basically what this is saying is if your business venture has zero possibility of ever generating taxable income, you can't deduct the expenses. Okay, and I actually said zero. We don't know what the number is, but if it doesn't have a reasonable expectation of earning $1 of income, of profit at some point, you can't deduct anything. You're not even in the deductibility party. But what we have to remember off the top, this does not equal to you have to earn profit in order to deduct. Okay, so not equal to that. So there are lots and lots of companies, actually most companies, when they start up, don't have enough revenue to offset all of their expenses, and so they have losses in their first years. That's perfectly fine. You can have those losses. Now, as we'll learn in a couple of weeks, you're going to have to carry those forward until you generate some profit, but you can have them. And that's absolutely fine. Okay, so we need to, first of all, very much separate the concept of expectation. This is not equal to outcome. Okay, so this is, hopefully, starting to sound familiar. This is similar to this whole idea of intent that we met with capital versus income. And so proving expectation is going to be just as difficult. And so, but again, it comes down, it's pretty intuitive for most people. When does a company have a reasonable expectation of profit? But there's some guidelines given. And it's basically, if it looks like this company has some expectation with a normal amount of luck that they would have some profit at some point. But they give us these general factors to look at. Okay, and I'm not going to go through these in detail. You can see what they are. How is it operated? Is it for personal use? And what I want to highlight, though, here is that some of these are based on the operator, and some of them are based on the activity. Okay, so activity, operator. Oops, that should have been red. Operator. Okay, so sometimes we're looking at, okay, so does the activity, so that you went into business and you decided you wanted to sell boomerangs. So does that activity have a reason? Is it likely that that's going to be able to be around long enough to generate profit for you? But when we think about number 7, your financial status, and that's actually a really interesting one. It basically says, if you're independently wealthy, then, this one can go either way actually, but if you're independently wealthy, we could conclude that you don't even need this thing to be profitable, and therefore you don't even care if it's profitable, and so you're not going to put in enough amount of time, enough effort. You could, of course, go the other way and say, well, you're independently wealthy, so you can continue to pour money into this thing until it finally hits. So either way, it's going to come in factors. Some of them are based on the operator, and some of them are based on the activity. Okay, but at the end of the day, just like with the intent on that, we're going to make a conclusion, and for the most part, if it's a business and it has a possibility of profit, then we're in. We're in the club. We are now a business operating with a reasonable expectation of profit. So once that is established, okay, so given that that's established, and in most cases that's a given, then what can be deducted? And here I've already come across a lot of misconceptions from students. So let's try to get this as clear as we can. The baseline is that every dollar that you spend is deductible. Okay, so the baseline is not, non-deductible until proven deductible. It really goes the other way. You're deductible until proven non-deductible. And really what this boils down to is 4 broad categories. We have of exceptions, things that aren't allowed to be deducted. Capital expenditures, and these trickle in, as we'll talk about. We've already met this, the sort of CCA, CECA. These are going to trickle into income, but we'll talk about how. Personal expenditures, specifically excluded. We've talked about that actually already. Unreasonable expenditure. So this is not the nature of the expenditure. This should really be unreasonable amounts. So nobody's going to judge the reasonableness of the thing that you buy. It's the amount that you pay for it. And then the broadest category, the most important category, is these specifically denied things. Okay, and we'll get to those just now. So the way, or before we get to that, here is something really, people have said. It came up on a quiz in one of the sections, maybe even the first quiz we ever gave. People out there, a lot of people, seem to think that tax uses the cash basis of accounting. It does not. The baseline for tax accounting is GAAP or IFRS, however you want to refer to it, financial accounting. Okay, so that's the baseline. So you can say if it's an expense for GAAP, it's deductible for tax. That's the baseline. Okay? So I know that other people have, so there are exceptions, okay? There are cash basis things. We're not saying they're not, but it's like fisher people, fishers and farmers. I know I'm not using the right term there, but anyway, farmers and fishermen, I think that's the proper term. They can use the cash basis. They can, but that's about it. Okay? And there are definitely some provisions that say you cannot use accrual in this particular case, and the language is very clear, and it says when it's paid. But that's generally the exception. So if GAAP says it's allowed, or GAAP says it's an expense, then tax says, okay, deduct it. Now, I think probably one of the places this misconception comes from is the fact that we focus a lot on the ones that tax says, no, you can't have it. But please understand that accrual accounting is the basis of income for tax purposes. Okay, so here is, I hope, a helpful way to think about. So here it is kind of equation-ish, and on the right side is Venn diagram-ish. Okay, so it's basically showing you the same thing. And the way to think about this is, when we want to kind of build the universe of what is deductible from business income, everything is, minus what's prohibited by Section 18 and Section 19, and we'll look at those just now. And then there's some exceptions to the prohibitions. Okay, so it's within this blue circle here, some orange is added back by Section 20. It says, okay, you kicked it out, but now we got to bring it back in. So the analogy I use here, I can't draw it, is the Section 18 and 19 is like the big tuna nets, and Section 20 is the work we do to cut out those cute little dolphins. Like, we don't want the dolphins caught in the big net that says nothing is deductible. We want some of the dolphins to get through. We don't want the tuna to get through. Okay, I don't know if that works for you, or if you've ever seen footage of such things. And then there's also this important thing, amounts in excess of limits. So we will cap, we will say, yeah, it's deductible, but only up to this point, and we'll meet a few of those. Okay? So, Section 18, Section 19, they say no deduction shall be made, and then they list what. So this is the one we'll look at specifically, capital. So if you make a capital expenditure, if you go out and buy an asset that has a life longer than a year, it is not deductible. End of story. Okay? Others that we will meet, they're very specific. Club dues. We've already met this one, payments under the Act. And then there's these two, and this one, again, there's misconceptions here, as I'll point out shortly. Reserves and workspace in the home. These have unless provisions. Okay, so, and more often than not, those unless provisions are met in the standard course of doing business. Okay, so generally it says no reserves. We don't like you to accrue expenses, but lots of them get in. Okay, and then there's a couple others, and then Section 67 is about the limits. So it's saying, yeah, it's deductible, but only to a point. So meals and entertainment, we've already met this. And then interest on loan to buy a car. Basically, this is very similar to that $30,000 Class 10.1 cap that we met. Remember? It's basically saying if you're going to go out and buy really, really expensive things, we're only going to fund up to a reasonable amount of that. So that's what these are consistent with. We're gonna limit the amount that can be deducted. Okay, so that's the net. That's the net that's caught all these tuna, and unfortunately has caught several dolphins as well. It says you may not deduct this. Please understand, this is not an exhaustive list, but these are kind of the more common ones that are help us to understand the principles. Then Section 20. Or subsection 20 sub 1 comes along and says, but notwithstanding what you've just said can't be deducted, here's what can. Okay, so and this is the big one for us to understand. It's saying, okay, Section 18 says not a dollar of capital expenditure gets into income as a deduction. And this Section 20, subsection 20 sub 1 comes along and says, yes, it does. We will trickle it into income according to our schedule, right? So these are the CCA classes, and we know all about that. Okay, and so there's other ones that are like that, sort of specifically prohibited by or caught in the net of 18 that we say, okay, we can get this through. So, for instance, landscaping for financial accounting is often added to the value of the land, a non-depreciable asset. So tax says, yeah, let's bring that into income. Other things, and this is the big one I want to talk about for a second. So another common misconception, I'll refer you to this point in the textbook where it lists and says, so a lot of people think, is bad debt expense deductible for tax purposes? And the answer is yes, it is. Okay, subject to the conditions that you'll see there, but in general, yeah, if it's in your revenue but it's doubtful to be collected, then yeah, you can have that reserve. Okay, so I'm not sure. I think I know where the misconception comes from, because the textbook earlier on says reserves are disallowed, but we need to note, as we did here, that there's a failure to note these asterisks. And that there are lots of reserves that get through that net. Okay, so hopefully that is clear. So what I'm going to try to do as we do these problems, and again, this is just going to be it's going to be a series of yes, no, deductible or not questions. And so what I want us to do is kind of hopefully build some intuition to say, you know, some of them we're just going to have to say it just is. Like when we get to the point and say, why is that specifically excluded, or why is that specifically allowed? We may get to a point where we just have to say it just is. But I'm hoping that if we think about it and think, you know, what was going on there. So I picture this as like a round table of people saying, okay, we need to set a law, and they all have different thoughts and ideas. And if we can think of it that way and say, okay, yeah, I guess it makes sense. I guess it makes sense that you shouldn't be able to deduct a life insurance premium that a company buys on the CEO's life unless. I mean, yeah, I guess that makes sense. And maybe they won't make sense, and so you'll learn to figure out which ones go opposite your intuition. But we're going to try to build intuition rather than just memorizing very specific things. Some of them are already locked in most people's brains, like 50% of meals and entertainment, but some of them just never seem to hit intuition. So we're going to try to build that. Okay, so I brought in exercise 12 just to quickly go through something here to kind of talk process. And this is, so you have a solution. So this is exercise 4:12. This is in the supplemental. So the solution to it is in the supplement to the textbook. So I'm not going to spend a great deal of time on it. But basically what I want to do is just talk about each of them in turn. So the provision for income tax, that one is, we just met, is prevented. These are payments under the Act. So we always add back tax. And so our starting point, you can either think of it this way as 150, and then I'm going to add back 25 and 130. I think I'm just going to switch to dollars at this point. So you can think of it that way. So here are the adjustments. Okay, but I'm not really concerned about us getting to the right number, because you can get to the right number. So let's just look at this in isolation. So part C, is that denied? Yeah, well, it is denied, but this is a temporary difference. So it's you're allowed to have some expense, but just not that expense. And it actually tells us in the question, ignore CCA because it's too early in the textbook. Okay, so we would normally bring back CCA, but we are absolutely going to add this back. Okay, we'll skip inventory for just 1 second. Okay, so interest on income taxes paid after the due date. This is a payment under the Act. That's a permanent difference. That will be added back. Okay, not deductible, specifically prohibited. Okay, and there's no provision in 20 to get it back in. Bond interest expense, including an annual discount amortization. Okay, so we have two pieces here. We have 39. Is there any reason is there anything that prevents interest expense from being deducted? We don't know whether it's been paid in the year. We just know that that for financial accounting purposes they've incurred interest expense. And the answer is we are only going to add back the amortization. Okay, so whether or not that interest has been paid in real dollars, financial accounting says that's the amount for the year. But there's a specific provision in 18 that says no amortization, because it's basically an accounting concept. You don't deduct it for tax, because it eventually hits you economically as the interest is paid. Accounting comes up with these discount amortizations. We don't care about them. Okay, so whether that's permanent or temporary, I actually argue it's permanent, but either way, we're adding back $7,500. Okay, landscaping costs, and it tells us it was debited to the land account. Okay, so we know this is non-depreciable, and so what that means is that's never going to come to income for financial accounting purposes, and so it really is a permanent difference, and we're going to add it back. Okay. Wait a minute. Oh, I read that wrong. Yeah, of course I did. What they're saying here is they debited it to the land, so this is actually not in this 150. Okay, so this is not in here. I just realized I read that wrong. Okay, so what we need to do is get rid of it. Sorry about that. Okay, so everybody clear? Landscaping costs, re the factory premises, has not been deducted from income. We need to deduct it because it is specifically allowed by section 20 sub 1, and so we need to deduct it to get to our number. Okay, so that's how that works. Now the inventory, this is somewhat rare, but basically very few people out there are using LIFO, but they just happen to be using it. So what we need to do is we need to reconcile these two numbers, and you can do this two ways. The intuitive way for me is to say that the opening balances is an increase of 15, and the closing balance increase is a difference of 10. I meant to change color there, sorry. Okay, so we have a difference here of 5. Question is, what way does that go? And so what tax says is you can use LIFO for accounting if you want to, but you have to use FIFO for tax. So what we need to do is reconcile what they've got on their books. So do they have too much expense on their books, or do they have too little expense on their books? As it turns out, they have too little, and so we are going to subtract $5,000 from the income that tax came up with. Okay? So hopefully that's clear. What we are going to do for the next, so the first, what we're going to do for the next two classes is a whole series of these, and it's basically one off. So it looks like one big question, but it's one at a time. Let's talk this through. Let's figure out what should happen. What is it, deductible or isn't it, and why? And hopefully we'll start to build a good base of understanding.